Got to have some metal, wake everybody up. It's the end of the day, right? And actually that song has something to do with the presentation. I don't know if anybody here recognizes that was Breaking Benjamin, and it's called Simple Design. And obviously, lending is not super complicated, right? But as we've seen in the last kind of debacle here with DeFi, Celsius, Three Arrows Capital, a lot of these guys, they made it super complicated. And the results were not very good, obviously. And a lot of those guys we were counterparties to in trading and all of these things, but we did not take the risk that they did. And in fact, we didn't have any issues during this process because a couple of things we're going to talk about here in this presentation. So a little bit about Smartfi. We started lending in this space years ago, and our first customers were miners. And we've lent to miners in Europe and Asia and South America and the United States and Canada. And we noticed a few things during the last several years of this process. That one, the processes were going to get tough because of liquidity, right? So here's what happens, and we'll go through this in just a minute. But we built the structure of our company around being rewarded for joining a community that funds loans. So we have a token that you can actually buy. When you buy that token, it funds our loans. And we'll talk a little bit more about that, but it has a 100% buyback guarantee, which nobody else does. So we'll talk about that in a minute. Let me get my arrow going here. And so we're going to talk about what happened with these guys that over-levered, got in trouble, and then what's it going to be like in the future. So the combination of DeFi and crypto lenders was a little kind of it's a confluence of too much risk, right? And excessive growth. So when you think about, is it ever a bad thing to grow too fast? Yeah, definitely. You go from a company like Celsius that in 2018, we were doing some lending projects, and they started coming around as well, and they raised some capital, built their platform, and started doing some lending. But they were about the same size as we were, but they went from, essentially beginning in 2018 to, I think they peaked at asset value of $20 billion in about 36 months. So if you have an issue where you need to stop out a loan or stop out some risk with Bitcoin because you're lending against Bitcoin and the price is falling rapidly, where do you go to sell $20 billion worth of Bitcoin to stop out the risk? There is nobody that'll take that, right? There's no liquidity big enough in the space to stop out the risk. So effectively what happens is it starts going negative, right? So those are some of the things that were facing those guys, and they couldn't stop taking the money or the crypto, right? And they were paying out. They always paid. We watched because we marked our prices against theirs and other groups, but they were always marking 2% above everybody else when they were paying out their coin interest accounts. So when as they took in those assets, they had to go to riskier and riskier propositions, right? DeFi, Luna, all these other projects, right? They were taking place because they had to still return it, and it started becoming a little bit like a Ponzi scheme, right? So there are always bad actors in a space because they can't say no, right? Somebody has to tell them no, and there are plenty of times when people have come to us with projects or with assets and said, hey, we want you to take this, we got this stuff, and we tell them, no, we're not doing that because we can't quantify the risk. We don't have the liquidity to stop out the risk. It's one thing to take all the assets, but it's another thing to form a hedge, right? Which, if everything goes bad, you have to get to zero, not below zero, not above zero, but you have to get to zero, right, to have a directly correlated hedge. And that's what you cannot do if you're too big. You start putting the assets in risky places. So that's what they started doing. Here's, and this is not new, right? If a promised return is too good to be true, it's too good to be true, right? 19, 20% rates coming from Luna and from USDT and all of the other DeFi projects are not sustainable. It's not real. And everybody said, oh gosh, the protocols, we're doing all these great things and fantastic different things. It doesn't exist. I don't know how many times people are going to have to learn that, right? Somebody's giving away 20% rate of return annualized on a project, on software. There's something wrong, right? So, I guess we'll kind of talk about this too. We got approached a lot by people saying, hey, why don't you put your assets in our DeFi project? Let's go test it out, do all these different things. And we just said, no, we're not doing. We have a few customers in this audience, right, that we had conversations about, these exact conversations, and said, no, we're not doing it. And they took their stuff and went somewhere else, right? But at the end of the day, we were able to say, hey, we didn't get caught up in all of these things and didn't do it. I don't know what happened to their assets. So maybe some got them out, maybe they didn't. But at the end of the day, we're still here, still doing what we're doing, making loans, doing the things we do because we don't chase excessive returns, right? So that's a little bit of the warning, but the good news is there's people still here, and there are other lenders that were doing a good job as well, stopping out risk and making sure that they were not over-levered. I want to talk to you just briefly about how we do what we're doing, why do we do it, and kind of this innovation that we made, right? This innovation that we have in a token that has a buyback guarantee. When everybody hears this, it's almost like a product that's too hard to sell because, again, when we talked about too good to be true, people think that that's too good to be true, but yet they'll go chase a 20% rate of return annualized interest and believe that, but not believe that a token will have a buyback guarantee. So the simple version of this is that when you take money to a bank, right, or a trusted bank where you think, hey, I guess we're going to have some trust in a bank, and you put money into a bank, you always expect to be able to go get back exactly what you put in. But what do they do with the assets? They lend, right? And in some cases, DeFi protocols were doing the same thing. But the difference was they were putting these assets in trading propositions, right? Or basically a thesis that said high-frequency trading was sustainable. It's not, right? And the reason is you have to slow down the train when it starts to come off the tracks, right? And there's no way to do that in a protocol. There's not enough assets, there's not enough decision-making, all of these other things that go into the process. And so in this process, what we do, we're actually making loans from crypto to the real world in some cases. We had about 1/3 of the portfolio in real estate and in equipment loans. We started doing this last year, which when all of this was coming off the rails 6 weeks ago, did the guy that borrowed the money for his tow truck still show up to work the next morning? Yeah. And he still towed cars. He still had cash flow. He still was doing the same things that he was doing, right? And that is a big difference between a DeFi protocol and a real world business that it slows down. You can't grow fast. You can't go from 0 to $20 billion in 36 months. But at the same time, you don't go from whatever you're at to 0 in 2 weeks, right? Big difference. And so with Smartfi, really what we're talking about is being first, right? Safety first. Put first things first. Safe. Make it simpler, right? The song, have a simple design, right? And with doing those things, then we can offer buyback guarantees, just like when you go to a bank and you deposit money, you expect to be able to go back the next day and get the money back, or whenever you're going to go get it back. And that's really what we've structured with the token, but it combined the ability of the networking effect with the token. So the token can actually go up in value, but we give a guarantee that if it goes down below whatever price you bought it for, you bring it back to us after a year, right? There's a lockup period in that part, but after a year, you bring it back to us and we'll buy the token back from you for exactly what you bought it for. Because we're not buying Ferraris, we're not building our platform or software with raising a token or any of those kind of things. We're just making loans, simple and straight like a bank does, right? but we're also requiring the right amount of collateral. We're also putting together a structure that is safer in this process so that you have the ability to come back and get the token or buy back. We'll do either one of those things, right? So it's kind of the best of fiat banking and the best of the cryptocurrency world. I want to talk about portfolio diversification. When everything is locked up in a trading protocol, you have no diversification, right? And this is not like, rocket surgery or some giant, newfangled idea, but it is different that we start in the crypto world and go back into the real world. Most people are going from analog world into the digital crypto world where there's a lot of risk, right? That still exists. So I want to talk just briefly about what this allows us to do in the future, right? Everybody asks us a little bit of what innovations we're doing, one of which is the token with the buyback guarantee. We've done $1 billion plus in loans and transactions with mining companies and doing these other things. But we're building a process, and you'll see this at the first of next year, that does utilize what we think is the appropriate use of DeFi, which is you can mine the interest from our loans, right? We started in the mining business. We love the mining business because it is hard to go from a large-scale business to zero. There's hard assets. There's actually work being done, right? It exists in the real world, and we like that concept. So we built a blockchain. We've been testing it now for about 2 years and doing some of these other things, and the modeling that we have in our business is mimicking that in the analog world. So when we launch it for the first time on a blockchain, it's not going to be untested like a Luna or something else. We've been doing it for years already. And I know we're just about out of time, but that's the innovation that we're looking forward to and encouraging and basically participating with the mining community in building other chains that actually utilize this technology. So I don't know if we had time for questions. I don't know what we're doing with that.
Let's open it up for one question if someone has something good.
Go ahead. And I'll repeat it.
Yeah. So could you address a few more of the risk characteristics for lending? I agree with you. They were over leveraged. There were some other things going on, also that contributed to that. And then the time piece on the 1 year, that's a component that mitigates some of that risk. Maybe unpack that a little bit more with the token and the buyback period.
Yeah, I mean, it all really comes down to executing on a protocol. Having something that can execute rapidly is good, right? As long as the prices are going up, right? When the market isn't cooperating, right, and everything is going down, you don't want something that can go from whatever number it is to zero in a nanosecond from a high frequency trade, right? That's bad. So the other thing is about what they were doing, right? They were taking in assets, deposits, trying to give returns, right? And then once those protocols were dumping and losing value, then they were also taking assets from the loans and trying to make up the difference and still paying things out. I mean, it was just a calamity and a collapse. It was basically a run on the bank by a DeFi protocol against this lending platform in the case of Celsius. Then in Three Arrows Capital, also levering up over and over and over through credit. So it wasn't super, mysterious, but I don't know if that's exactly what you were looking at. But I mean, with a lot of those guys, we did trades and did stuff. We stopped trading with them about a month into all this stuff because we could see that. And we were hearing things. It's probably what most people don't hear that we get from the counterparties because we're talking to their trade desk and we can hear and we see the behavior, right? When they start asking us for different kind of deals and they start giving us different rates, we're saying, why? What's the motivation behind this? And you start to recognize somebody's in trouble, right? So you cut it off. But I know we're way over time. So,
thank you very much, you guys. I think it's really important to look into people that have been around for the long haul and still are able to continue to stick around, especially during bear markets, especially doing what you guys do, providing loans. Definitely a lot of these loan companies went under. And a lot of people look at Bitcoin and they look at Bitcoin as a super risky asset. And maybe it is in comparison traditional stock stuff. But with you guys and what you're doing, you really take that risk away from the end user. So that's awesome. You guys give it up for Aaron.
Yep. Thank you.